How many of us have dreams of being wealthier than we already are? Pretty much everyone, right? Today, the vast majority of us simply try to rely on staying in a job and saving money as best as possible. True, it can help, but it is very difficult. Yet, there are some who take it a step further and decide they want to invest their money instead of saving it. It's almost their way of saving. However, instead of it being put away, it is applied to something that could possibly yield a larger return in the future. Everyone has had ideas of investing before, but so many times, we stop because we don't know the proper steps or because we feel uncomfortable taking the risk of the investment not earning a return. But if one were inclined enough to start pursuing some of these programs, and knew which ones to look into, they could actually do very well for themselves. Welcome to Finance Basics, and today, we're going over our list for top 10 best investments that yield a high return. If this is your first time to this channel, be sure to hit the subscribe button and the notification bell. We want to have you with us each and every time. Now that we have that out of the way, let's jump right into our list. Invest in the S&P 500 Index Fund. We've probably all seen something about this on the news, but what is it really? The S&P 500 Index Fund is made up of the 500 biggest and most powerful companies in America. It is essentially a stock market focused around companies that have a track record of success. People that choose to buy into these companies minimize lots of risk and produce strong returns over time. This is best for people who are looking for long-term investments. Young investors are especially suited for the S&P 500 because they will have time to weather some of the fluctuating markets that are sure to come. So, if you're new to investing and you're wanting to try something on the stock market, this is definitely one of the best places to start. Invest in growth stock funds. What are growth stock funds? It is a diversified portfolio of stocks that has capital appreciation as its primary goal. In other words, it is a collection of stocks that have a track record for success. However, if a person decided to invest their money, it doesn't mean that all of their money goes towards one stock. As a matter of fact, your investment would be split between a few stocks, all of which have histories of profits. This is a great option for beginner and expert investors alike. Over time, growth stocks have track records of performing very well. There are expert managers who oversee all of the cash investments. They personally select what money goes where. In a sense, you have your own personal stockbroker. Invest in dividend-paying stocks. It's no secret that people get into investing because it makes money. There's no shame in saying it. So, dividend-paying stocks is the way to go when you're looking to make a lot of money quickly and then turn around and sell it, right? So, this one is quite the double-edged sword. On one hand, the investor is exactly right. When you buy stock in an individual company, you are taking on quite a large risk. At any given time, everything could go wrong and the prices of the stock fall very low. There are very many people who lose money this way. But on the other hand, the market could go up and the prices of the stocks could start to soar. This is where people end up getting rich overnight. So, you have to decide for yourself if it is worth the risk of losing it all. Yes, the risk is nominal, but the rewards can be incredible. Invest in short-term corporate bond funds. Have you ever heard of bonds? Some of us remember hearing about them in history class. The United States would sell bonds to help pay for the war. Bonds are essentially loans that are taken out by a company or a country. However, instead of going to a bank, the company gets the money from investors, us, and pays it back at a later date. However, companies can do this too. Consumers like you and me can buy bonds from companies, hold on to it for a little bit, and then collect on it. During the time we have held on to it, it has been accumulating interest, meaning that we would be able to earn profit from the transaction. The best thing to do it in this situation is to purchase short-term corporate bond funds. These short-term bonds have an average maturity of 1 to 5 years, meaning it isn't being affected as much by changing interest rates. Invest in municipal bond funds. If you've noticed, these are more bonds to invest in. However, this time, instead of buying bonds from a privately owned corporation, you would be purchasing bond funds that are issued by state and local governments. It is especially attractive because generally, any interest earned on these bonds is not taxed on a federal level. And in some circumstances, exempt from state and local taxes as well. This investment is perfect for beginners because when you borrow money from such a public entity, they're sure to pay it back timely and properly. The only risk associated with municipal bonds is in the event that the city is in default and cannot pay you back. However, this is a rare occurrence and we recommend this to remain on your radar. Invest in government bond funds. Once again, we are back to the bond funds, but this time on a federal level. Government bond funds are essentially mutual funds that invest in debt securities. They are sponsored by the United States government as a way to pay off debt and to fund various projects. As we said before, they are borrowing money, and the people that they are borrowing the money from are those interested in government bond funds. This is a very low-risk investment and therefore is ideal for those who have never invested before. Additionally, should a person decide to get quite a few bond funds, they could create a steady flow of cash. The only thing to remember about these bond funds is that they are not immune to this like inflation and fluctuating interest rates. Invest in Treasury Securities. Here is yet another investment allowed to us by the United States government. If we're being honest, it's quite a bit like buying bond funds. However, what is happening here is that these securities are sold to buyers at a discount from their face value. If you decide you want to purchase $100 in Treasury Securities, you may spend $70. Now, here's where it starts to get different from the regular bond fund. Treasury Securities are meant to come and go in a very short amount of time. When bought, they generally come with a maturity of 1 year or less. Once again, this is a very safe way to invest, and if you can get multiple securities at the same time, the short terms will yield a nearly consistent stream of income. Invest in high-yield money market accounts. Everyone has heard of savings accounts. It's the place you store anything from a rainy day fund to your entire retirement fund. However, there is another type of savings account known as a money market account. There are two main differences between the two. First, money market accounts are very limited in how many checks you can write from it. Second, they earn much more interest, which is where we profit as investors. This is a good investment for someone who is simply looking to earn money without realizing he's earning money. He keeps the money in the account, that money earns interest, no one touches it for a while. And that's pretty much it. Invest in a certificate of deposit account, or a COD. As much as we all need bank, they need us too. It is our money being kept there that keeps them operating. So, they want us to touch our money as little as possible. So, they offer what are called certificates of deposits. These are products that are offered by banks and credit unions that provide an interest rate premium in exchange for the customer agreeing to leave a lump sum deposit untouched for a predetermined period of time. The reason we recommend this is because your money is making more money by doing nothing more than sitting there. While it may not give a constant income stream, it definitely pays off once the money is able to be withdrawn, with that premium interest. Invest in a high-yield savings account. Traditionally, people have gone to physical banks to keep their savings accounts in order. However, with the advent of internet-only banks, as well online banking from many well-established banks, there has been a healthy competition to see who has the better interest rates. This is how high-yield savings accounts came about. There are some savings accounts that typically pay 20 to 25 times higher in interest than what a standard bank would allow. Let's say you had $5,000 in savings at a bank. The national average is 0.1%. That means, over the course of 1 year, your saving account would only earn $5. However, if you put that same $5,000 into an account earning 2% per year, the interest would be $100. It's definitely the way to go. Do you agree with our list? What are some investments you would recommend? Let us know in the comments below. Don't forget to check out some of our previous videos for more great content. Thanks for watching. We'll see you next time.